If you still have all your cash sitting in a high-yield savings account, you could be quietly losing ground, and most people have no idea it's already happening. Welcome back. In this video, I'm going to break down exactly why high-yield savings account rates are falling in 2026, what that actually means for your money, and the specific places you should consider moving your cash right now. No complicated finance terms. No fluff. Just straight answers that could save you thousands of dollars over the next year or two. Stick around because the last option I cover is one most people completely overlook, and it might be the most powerful move you can make right now. So here is what is actually happening. High-yield savings accounts became incredibly popular when the Federal Reserve started raising interest rates back in 2022. Banks were suddenly offering 4, even 5% on savings accounts, which felt almost too good to be true after years of earning almost nothing. But here is the thing about high-yield savings account rates that most people do not fully understand. They are variable. That means the bank can change them whenever they want, and they are directly tied to the federal funds rate set by the Fed. When the Fed raises rates, high-yield savings accounts go up. When the Fed cuts rates, high-yield savings accounts come right back down. And that is exactly what we are seeing in 2026. The Fed has been cutting rates to cool economic pressure, and banks have already started quietly slashing their high-yield savings account rates in response. Some accounts that were paying 5% are now sitting closer to 3.5% or even 3%. That might not sound like a huge drop, but on a $20,000 balance, you could be earning $700 less per year without changing a single thing. The frustrating part is most people do not even notice until they check their statement months later. So now that you know why this is happening, let's talk about whether you should even be worried about it. Here is the honest answer. Your high-yield savings account is still a good place for some of your money. It is liquid, it is FDIC insured, and even at 3%, it beats the national average savings rate by a mile. So this is not about panic. This is about being strategic. The question you need to ask yourself is, what is this money actually for? If you are keeping 3 to 6 months of living expenses as an emergency fund, then your high-yield savings account is still doing its job. You want that money accessible. You want it safe. A slightly lower rate is worth the peace of mind and the instant access. But here is where people go wrong. They park everything in a high-yield savings account, including money they will not need for 1, 2, or even 5 years. That is the money that deserves a better opportunity. Leaving long-term savings in a variable rate account that is trending downward is like keeping your whole wardrobe in the entryway closet because it is close to the door. So the real question is not whether to keep your high-yield savings account. It is whether your high-yield savings account should hold all your cash. And spoiler, it probably should not. Let's look at where that extra money could go instead. One of the smartest and simplest moves right now is shifting some cash into short-term Treasury bills or a money market fund. These are not as scary as they sound. Treasury bills are basically short-term loans you give to the U.S. government, and they pay you interest in return. You can buy them directly through treasurydirect.gov with as little as $100. Right now, depending on the term you choose, you can still find Treasury yields that are competitive with or even slightly better than what your high-yield savings account is currently paying. And because Treasuries are backed by the U.S. government, they are considered one of the safest investments in the world. Money market funds work similarly. They invest in short-term, low-risk securities and typically offer better rates than traditional savings accounts. You can find them through brokerage accounts like Fidelity or Vanguard, and they are easy to set up. The key advantage here is stability. These rates do not drop overnight the way high-yield savings account rates do. If you lock into a 6-month or 1-year Treasury, you know exactly what you are getting. That predictability is incredibly valuable when rates are moving around. But what if you want something with even more growth potential without taking on a ton of risk? Certificates of deposit, or CDs, are another underrated option right now. A CD locks your money in for a set period of time, usually 3 months to 5 years, and in return you get a guaranteed interest rate that does not change for the life of the CD. Here is why that matters in 2026. If rates keep falling, a CD you lock in today protects you from those future cuts. You are essentially capturing today's rate and holding on to it. Some online banks are currently offering CDs with solid rates, especially in the 6 to 18-month range. The catch with CDs is that your money is not liquid. If you need it early, you usually pay a penalty. So this strategy only makes sense for money you know you will not need until the CD matures. A good approach is to ladder your CDs, meaning you open several with different maturity dates. That way, you always have some cash becoming available on a regular schedule. On the slightly more aggressive side, high-yield bond funds can offer better returns, though they do carry more risk than CDs or Treasuries. These are corporate bonds from companies with lower credit ratings, which is why the yield is higher. They are not for your emergency fund, but for money you can leave alone for a few years, they are worth a look inside a brokerage account. Now here is the option I mentioned at the beginning that most people sleep on. The most overlooked move for cash that you do not need for 2 or more years is simply putting it to work in the market through a brokerage account. I know that sounds obvious, but so many people sit on tens of thousands of dollars in savings because the market feels risky, while inflation quietly chips away at their purchasing power. Even a simple low-cost index fund has historically outperformed savings account rates over any 5-year period. You do not need to pick stocks. You do not need to be an expert. A basic index fund through any major brokerage gets you started. And then there are I-bonds. These are inflation-protected savings bonds issued by the U.S. Treasury. The rate adjusts every 6 months based on inflation. When inflation is high, your I-bond rate goes up. They have limits on how much you can buy each year, and you cannot touch the money for 12 months. But for a portion of your long-term savings, they can be a genuinely powerful hedge. The big picture here is simple. Spread your cash with a purpose. Emergency fund stays in your high-yield savings account. Short-term savings move into Treasuries or CDs. Long-term savings go into the market or I-bonds. That single shift could make a meaningful difference in your financial life over the next few years. If this video helped you think differently about your cash strategy, hit that like button right now. It genuinely helps this channel reach more people who need to hear this. Subscribe if you want more straightforward money videos like this one. And drop a comment below telling me where you currently keep most of your savings. I read every single one and I would love to know what you are working with.